Welcome to Founder Radio. I'm your host, Hugo. In this podcast, you'll hear in-depth conversations with the globe's most exciting company founders. We'll talk about their ideas, their successes, their challenges, and their learnings along the way. At Founder Radio, we celebrate founders, and we believe that innovative founders are critical to deal with the challenges humans face. They are society's explorers and work in uncertainty to expand our practical knowledge each and every day. Building something from scratch requires creativity, intelligence, conviction, and endurance. Get inspired and learn from those that are changing the world. Hello everyone, welcome to Founder Radio. Today we're talking to Tinashe Ruzane, co-founder of Flexclub. Flexclub is a vehicle subscription marketplace giving consumers flexible access to cars. I'm keen on hearing more about the founding story, the absolute roller coaster that has been, where Flexclub stands now, and about the man from South Africa that's been driving this business forward since 2018. Tinashe, welcome to the podcast.
Thanks a lot for having me. Excited to be chatting.
It's great to have you. Let's start at the very beginning. Why did you found Flexclub?
It's an interesting one, I think, one that you might appreciate considering our shared background and story. But really, the insight came across to me during my days at Uber. I was responsible for helping drivers access cars and started to realize that there was a new category of vehicle access that was emerging. A lot of noise. Folks were attempting to make it work. Folks hadn't really figured out how to make it work. But for me, it struck me as something that would resonate quite deeply in emerging markets. So I'm personally from South Africa, as you mentioned, and in South Africa, it's a very strong car culture. And given sort of the parallels or the overlaps there with my background in mobility, South Africa is a car culture, strong automotive culture, and the need for ride-hailing drivers to access cars. The initial idea was to offer subscriptions to Uber drivers. And that's what the mission was, make cars more accessible to gig workers. And over the years, that's gone through several twists and turns to the version of Flexclub that exists today. But that was really it. That was the underlying mission.
And at that point, at the beginning, what did you offer that wasn't there yet? Was it mainly for the drivers that weren't able to finance or buy their own car, or was it something else?
Yeah, primarily that. So I guess the other piece of context, for South Africa and emerging markets in general was the vast majority of ride-hailing workers would access their cars informally. They'd rent them informally on classifieds portals through what Uber would call fleet partners. A fleet partner could be an individual that just has one car and then rents it out to an Uber driver. Over 80% of drivers were accessing their cars, through that mechanism. While that's great as it democratizes access, a lot more because there's a greater risk appetite from fleet partners, it also leaves them vulnerable to exploitation because there's no formalization there. And that's why we felt that building a new platform or layer that facilitates formal transactions between drivers and fleet owners would be a good starting point with the goal of actually working with much larger fleet owners in time.
Makes a lot of sense. And so you decided to start this business. You were in your office or somewhere else. Could you paint a picture of what that first year looked like?
It was quite surprising. I think I am still a first-time founder, so I didn't really have any context of what to expect. Once I left the mothership, so to speak, obviously the comforts of the Uber hallways, super well capitalized, and the way experimentation worked, where suddenly now, you're sort of responsible for everything and realizing that a lot of machinery that you took for granted when you're in a much larger technology organization. And secondly, obviously the reception from the ecosystem to any approaches was very different. Always nice when your email signature says, I'm such and such from Uber. How differently you're received to I'm Tinashe from Flexclub. So really had to get back to basics and find innovative ways of building momentum. So that first year was really just about that, testing a lot of things, trying to find momentum, take the idea a bit further. Obviously, the idea was just a starting point. And I had some conviction on the path I wanted to walk through. But a lot of those things were assumptions, unknowns. So the first year was really about experimenting, figuring out what works, what doesn't. And suffice to say that after 12 months, we changed the business quite materially away from the original idea that we initially pitched to investors.
Could you go a bit deeper on that? Like, what did you learn in that first year, and consequently, what tweaks did you make to the business model?
Yeah, so when we started the business, the general idea was to build an intermediary layer or technology platform that facilitates transactions between fleet owners and Uber drivers, where the assumption was that those fleet owners would be larger fleet owners, while also still accommodating smaller fleet owners if need be. And what we found was the larger fleet owners were, less keen to work with an unknown quantity, and we had to go all in on smaller fleet owners. There's a different operational motion that's required to support an individual car owner versus a fleet owner that owns thousands of cars. And while building, for that individual fleet owner, we just realized that the scale limitations of having to find an individual on the supply side and an individual on the demand side was incredibly complex and capital intensive. And we then started to figure out, well, maybe we should actually move to be our own sort of captive supply and build our own fleet. And that's when we started to talk with debt funds and the like about rather providing us with the capital required to go buy fleets of which we'd manage would be a lot simpler from an operational perspective, but then it created a different burden, which was more on the capital market side. Now we needed a motion to go raise capital to fund fleets. But also, as soon as we figured that out, COVID happened. So just as we thought we were going to make this commitment to a different, motion, COVID forced us to scrap that and go back to the drawing board.
And before we go into that, where did you stand after that first year? Like, maybe I'm just thinking of the technical platform, the cars, the users. Like, what was the status of the business after those first 12 months?
Yeah, so the first 12 months, I guess by most accounts, you could say it was quite small relative to the size of the total Uber driver population. So we built it to 300 cars that we were managing on the platform in South Africa. We then also started investigating the prospect of expanding into Mexico. So one of my co-founders at the time, also ex-Uber, was one of the early employees in Mexico and understood the Mexican market very deeply. We're kind of putting in the work to research whether that was a good extension of the idea. And we built conviction that we could replicate, considering it had similar dynamics around fleet partners, etc. And so that's where we got to by the end of 2019. But then because of that success, we then started to get this inbound interest from credit providers or alternative sort of credit providers, saying that they were looking for the interesting assets to deploy, get yield. We had obviously now got the data showing what yield could be delivered on a car. Then started to progress those conversations and move direction closer towards them.
And a new phase started. Could you tell us a bit more about, I guess, how that started, and also how COVID probably threw a spanner into the wheels?
Yeah, sure. So, I think a big part of that shift for us is, the yield promise to the credit provider was premised on there actually being utilization of the fleet. And COVID fundamentally disrupted that. At least in the case of South Africa, it had extremely hard lockdowns. Uber drivers were restricted in their movements for a few hours a day, and only if it was considered an essential service, even having military enforcing that lockdown in South Africa. It was a bit different in Mexico, but irrespective of how hard the lockdowns were, obviously the demand side of Uber was severely impacted. Riders were not riding. and that just meant drivers were not driving, or at least not earning. And so for us, we couldn't, obviously in good conscience, continue to deploy any of the capital that we'd now raised on the debt side. We'd actually just closed our first debt deal and had deployed some of it, thankfully not a big chunk of it, but it deployed some of it. I think we had purchased just over 100 cars, and then had to now figure out how to unwind that, renegotiate, considering this was obviously an act of God. And in parallel to that, also figure out what does this mean for our business. There was no clarity on how long this depression would exist, this mobility depression. I remember there was a tracker on, I think it was on Apple, that they were tracking sort of mobility movements in different countries and different territories. And that graph just wasn't looking very promising. So I think it was just a stroke of luck that led us to, the next evolution of what we would be as a platform trying to facilitate vehicle access. I think that the trigger for us was Hertz in the US filing for bankruptcy. That was a signal to us that there's an adjacent ecosystem that may be feeling pain as a result of COVID, and that might be more open to experimenting with us. Obviously, nothing spurs folks into action like a crisis. And so we then took it upon ourselves to start reaching out to every car rental executive that will take our phone calls.
What did you have in mind when you did that? Like, what kind of business model did you envisage in this phase 3, let's call it?
Yeah, so I think if I think about where the uncertainty was, at least in my mind, it wasn't so much that we're uncertain that there would ever be mobility again. It was more what kind of mobility would prevail, what category of mobility is resilient in a world where people don't want to be. I mean, at that time we thought we might not ever want to have contact with each other the same way we do now. And so we said, look, people will still need to move regardless. No virus is going to change that. But how they move will change. And we thought that personal mobility, driving yourself around, your own private car, there was still an opportunity there. In addition to that, COVID, I think, placed a lot of economic pressure on a lot of folks that made them rethink some of their long-term commitments. Now if you got retrenched or your job scope was reduced during COVID because your company was trying to figure out how to become more resilient, through this time, a lot of folks would realize that their underlying costs in the household are relatively fixed and fixed for many years because there's a mortgage, there's a auto loan that's locked in for the next 5 years, and so we figured, how can we be part of, a wave of services that comes to market that unlocks greater consumer resilience, allows folks to adapt their mobility needs, but still resembles all the benefits of ownership, the same way an auto loan might be able to deliver. And that's how we figured that transitioning from car subscriptions for workers to car subscriptions for consumers made sense. And given the nature of car rental companies, their core business was serving consumers, but not necessarily for car subscriptions, but providing them with cars for a shorter duration of time. I guess that was the other sort of understanding we had, and maybe the unique advantage we had because we had the Uber experience, understanding the spectrum of mobility exists on a spectrum of time. There's mobility by the minute, mobility by the hour, by the day, by the week, by the month. And I think we were very focused on mobility by the week for the worker. We said, well, how about mobility by the month for the consumer? That's not a space that seems to be well catered for. It's really the banks that dominate there. And in a world where salaries are under pressure, their own underwriting might be under pressure. Their risk appetite is not likely to be higher. So they might not be approving as many people, but people still want to move around. We thought that would be the perfect opportunity to bring this idea to the table of car rental companies.
And how was it received, but both by the car rental companies and by consumers at the time?
Yeah, so I mean, in 2020, we're really just, because obviously these are much larger organizations, so the exploration process just takes a lot longer before we're actually able to put a product in front of a consumer. But the car rental companies, like I mentioned, Hertz had filed for bankruptcy in May 2020. We knew that all of them were under pressure to find utilization for their fleets. They had massive commitments underpinning those fleets. And they were doing radical things. I think part of the signals that we were seeing is the car rental companies in South Africa were even trying to figure out how to get into grocery delivery. I think that it's just really captures the time. And so, needless to say, there was an open-mindedness by some, mind you, not all. I think some executives felt that it was nonsensical for them to drift too far away from their core, their bread and butter, which is short-term rental, do what they've been doing for decades. This is just a blip. It's just a matter of time before this goes away and tourists are back and travel's back, and short-term car rental is the way it always was. While others, I think, maybe wanted to be a lot more prudent in how they kind of approach, their suite of products and diversify. So two car rental companies in particular, basically, said, look, we're open to do this with you guys in South Africa. Just to be clear, we want nothing to do with the worker segment. We were very focused on consumer. The work that our platform did on the worker side was also assess the risk profile of the end user of the vehicle. Initially, when we launched Flexclub, we were integrated with Uber such that we could see that data. We could see, what is the rating of a driver? How much money do they make? How many hours do they spend on the Uber platform each week? And that would be the basis of whether or not they could access a weekly subscription. Well, obviously on the consumer side, we didn't have any of that infrastructure. So we had to kind of figure out now, how do we kind of stitch together something that makes sense to assess that risk? It also just happened to be a time where open banking was also now all the rage. So now this idea of proliferating access to consumer data was really coming to the zeitgeist. And we were able to work with some early pioneers in the space, in South Africa at least, to get that data, build a basic underwriting model, at least a way to assess the risk profile of this consumer. And then we launched with Avis in South Africa at the beginning of 2021, really.
Why were the car rental companies so keen on working for consumers only? Also, given that you had all the infrastructure and all of the data to assess basically the quality and the credit worthiness of the Uber drivers that you were planning on catering to before?
Well, a couple of reasons. One is there weren't many great examples of large fleets serving workers, ride-hailing drivers with great success, not even in developed markets. And I think the number of reasons why that's the case, obviously that was part of my job at Uber, was to help folks feel more comfortable about doing that. But that was one area of caution, particularly car rental companies never managed to make it work well. The second piece is the market was still depressed. So there wasn't, we could also see the data, given our own integrations with Uber and the existing ride-hailing drivers that were subscribing for vehicles still on our network at the time. You'd see that they weren't earning enough to actually afford the subscription that would be priced by the traditional car rental companies. And then the third piece, which I guess is still relevant today, is these businesses, fleets like car rental companies, are used to providing vehicles to end users with a specific mileage profile. And mileage is very, very important because it influences the remarketing value of that vehicle at the end of its life cycle. So for a typical car rental company, that life cycle might be a year to 2 years. So just to put it into perspective, an average consumer, at least in South Africa, would use a vehicle, maybe 1,500 to 2,000 kilometers per month. An Uber driver would use a vehicle 6,000 to 8,000 kilometers per month. So now you're just depreciating this asset a lot faster. You just need to now dispose of it a lot faster. Add in the fact that in the automotive market, used car market was was a bit wonky because of COVID. So all that uncertainty just made that just less appealing. And they said, look, let's just try to reduce the unknowns. The biggest way to reduce the unknowns is to focus on the consumer market.
Makes sense. And was that the latest iteration that you went out to the market with?
So that was the iteration in 2021. Mm-hmm. I think our business has evolved even further since. But that iteration is what led us to the insights that we found now, not without difficulty and not without scars in or from the battleground, so to speak. I think the business in 2021 saw incredible growth, which attracted greater capital interest in our business in 2021. But now, obviously, in hindsight, we realize that not all of that may have been due to us. I think it was a general optimism that surrounds the ZIRP era. I'm sure a term that's been mentioned several times on podcasts like this. But so we saw incredible growth in 2021. We attracted a bit more capital. We had a different business model where we started to feel that with sufficient scale, we'd be happy to absorb the consumer risk. Because we felt that in time we could build an engine that underwrites that consumer risk for larger fleets whose core business is not to underwrite that risk, mind you. So they don't operate like banks or leasing companies. And yeah, as a result of where capital markets went and where we were at the time that sort of capital markets started to recede in 2022, we then had to make some very hard transitions away from a model where we absorb risk and really focus on, first interrogate, what are the things that we think we can do 10x better than the status quo using technology in a value chain for car subscriptions. And so our business today is very focused now on, first of all, just the clarity, defining car subscriptions or those that provide car subscriptions as a network. We now internally refer to them as car networks. So Avis is a car network, Budget is a car network. They're part of the same group. And I think it's also not too dissimilar from how other mobility businesses are defining themselves. I think I've even heard Uber refer to itself as a network more recently, especially in the context of self-driving cars. But to my earlier points, I think what we're starting to see now is there is a difference in network that focuses on by-the-minute mobility and a network that focuses on by-the-month or by-the-day mobility. Mm-hmm. And so we said, well, for networks that are focused on by-the-day, by-the-month, we can really build technology that helps level up the experience of the end user. How easy is it to build a plan and subscribe for a vehicle? We can really build technology that levels up distribution in the digital world. And we can really build technology that helps improve some of their underlying operational efficiency, get more from what they have. And that's really where our platform is focused now, where we focus specifically on pay as you go, or what some might call prepaid mobility or prepaid car subscriptions, where a customer builds a plan, tops up their account. Very similar to cellular plans. I think we took a lot of the inspiration by analogy from the telecommunication space, and have brought that thinking into the world of by the month mobility networks, and that's been an interesting place for us to really differentiate from other technology platforms out there.
Can totally imagine. Like the mobility by the minute or the hour is well catered to by the Ubers and the Bolts of this world, but like I'm not familiar with any kind of company that offers like Flexclub does, like by the week or by the month, right? It's all super old school still. So I can totally see that there's a big opportunity there.
Absolutely.
And in that category, you have some good news to report on. Could you elaborate a bit on the recent announcement?
Yes. So just this week, we announced that Avis has now launched its own pay-as-you-go subscription brand or network on top of our platform, which is super exciting for us. I think we basically launched or relaunched Flexclub as a brand, as a pay-as-you-go virtual network around Q2 this year, and I've been experimenting with it. So using Flexclub, the brand, as a test case, sufficiently proved it to to Avis. They're now running their network on top of our platform and already have a series of other brands in South Africa now looking to build their own virtual networks, interestingly. And I can also elaborate on, what do we mean by virtual? I think, again, this analogy between mobility and telecommunications. In telecommunications, you have mobile network operators and you have mobile virtual network operators. The distinction being who owns the infrastructure and who operates the infrastructure. And even that definition is actually evolving now. So you would have a network like, let's say, an AT&T, Vodafone, that basically are the mobile network, and they have a mobile virtual network that sits on top of them, which is a separate brand, leveraging their tower infrastructure, etc., billing systems to offer a proposition to an end user. And so now we as Flexclub proved that we could build a virtual network sitting on top of Avis as a network. They were the first underlying network that we integrated with. And they've also launched their own proposition now and using that same platform to enable prepaid or pay-as-you-go subscriptions, the idea of topping up for a car as and when you need it.
Got it. And is it fair to summarize the operator approach that you take now is that you basically link the owners of the network, i.e. the cars, with companies and parties that have the distribution and that appeal to a certain segment of the market and that can trigger those users to actually use the cars on Flexclub?
Yeah, I think that's right. Because I think it's also, I don't think any of this is new, the idea that different brands penetrate different segments. I think you just never really had the infrastructure available that would allow for a car network like an Avis to have penetration to multiple segments through multiple brands, unless they launched those brands themselves, which of course is very expensive. It's expensive to build a brand from scratch. But this is why I think, where MVNOs in the telco space have gotten to, now you have retailers, banks, insurers launching their own MVNOs, what some might call a thin MVNO, where their only responsibility is sales and marketing, to the end user, but the underlying machinery underneath the network is still the network, who's now focused on driving a wholesale channel. That's just unlocked greater transaction volume through the pipes. Looking at telcos, and in the case of mobility or in the case of these car networks, I think that's the opportunity. There might be, hypothetically, there might be a brand that's very focused on the youth. There might be a brand that's very focused on professionals. And they could very easily, in a bid to really extend their engagement with their customer base, they could really just expand, their product suites to include mobility now, without needing to take on the operational lift of running their own fleet, buying their own fleet, financing their own fleet, and. I think, as we discovered, it's a very complex process. And the reason why I think maybe a lot of sort of folks that are not as plugged into the mobility world fail to appreciate is there's a reason why that businesses like Avis and others still exist and still do well, because they've really built a strong capability around fleet management and the management of the underlying infrastructure, which is both sort of movable asset and fixed infrastructure, parking lots spread across the country. It's quite a feat. And so I think we just chose to rather focus on enabling them instead of trying to build our own network from the ground up.
Yeah, not easy to replicate at all. And for those parties, are they interested in working with Flexclub from a utilization perspective to basically sort of get as many users as they can service with the existing assets that they have?
Exactly. It's basically maximizing sort of utilization of the underlying infrastructure for which you have CapEx committed. I think there will also be an evolution there. I suspect that, it's just a question of when, but you're already seeing there are conversations happening on the by the minute networks. What's the evolution of infrastructure there? I think in the case of Uber, infrastructure was always decentralized infrastructure. It was always going to be the individual driver comes with their own car. Maybe you have a massive fleet that's offering, cars to those individual drivers. And I think that's where we initially thought we could play a role, but then realized Flexclub in particular wasn't best placed to solve that problem. I think there are other businesses that are well placed to do that. But now in the era of autonomous vehicles, that infrastructure is going to look, more and more. It's just going to change quite a bit.
Mm-hmm.
So I think until that happens on the by the month space, the likes of Avis and other car rental companies are going to continue to own this infrastructure and will want to maximize utilization of the infrastructure, really get maximum bang for buck there.
And if you imagine a world where there's plenty of access to autonomous cars, say extreme case, like 90% of cars are autonomous vehicles, is Flexclub ready for that future, or would you have to make significant tweaks to be ready?
Yeah, so I don't think because the role we've chosen to play now is focused really on the distribution of the mobility package to the end user, the actual prepaid billing that happens when a customer takes on a monthly subscription plan, as an example. So regardless of how that underlying infrastructure is managed and how it's kind of put together, I think there will always be a need for that to be distributed to end users, and also there'll always be a need for end users to manage the billing, especially if it's prepaid in developing markets like South Africa. So I think that as autonomous networks evolve, you'll also start to see maybe an increasing participation of even the traditional fleet managers. I think in 2017, when Waymo, was really starting to make a lot more noise, they did a deal with Avis at the time. I'm not really sure if that deal even still exists, but they did a deal at the time for Avis to manage the Waymo vehicles. Because just because the car is driverless doesn't mean it cleans itself. It manages itself, changes its own tires, and. So I think that shouldn't be discounted. There is a strong fleet management capability that will always be required, even in the era of autonomous vehicles.
Makes a lot of sense. And Tinashe, we discussed the ID maze before, term coined by Balaji, entrepreneur and investor, and it's basically to describe a maze where you sort of walk around and learn what directions don't work, and then turn around and find something else, and then eventually come out of the maze wiser and knowing everything that's there to know about a certain sector. If you zoom out and look at your journey from the very start to now, what are the key learnings about this market of flexible mobility that you learned over the course of 6 years?
It's a very long list, but look, I think the idea maze it's a great mental model through which I've also reflected on the most recent journey, because the 2 years that preceded us coming up with the latest iteration of Flexclub was a difficult 2-year period, considering where capital markets were and what we had to do to navigate that, and we can double click on that in a bit. But a lot of the assumptions that I had were really a series of decisions and choices I had thought about quite a lot over the last 5 years, and even you could say maybe even the 4 years that preceded those 5 years while I was at Uber. So I spent a decade thinking about this, and a lot of the things about the maze are that as much as you might have domain expertise, it doesn't necessarily guarantee that you know what the answer is. You may have a point of view, and for each sort of fork in the road, through the maze, I think there were some hard lessons to be learned. As an example, the very first choice we made: should we own the underlying infrastructure, or should we partner with folks that already have their own infrastructure? It's a fundamental business decision, and you can make assumptions. If you've never owned and operated your own infrastructure, you can make some erroneous assumptions there around what it takes, and whether or not, specifically as a technology business, whether or not technology can 10x your performance relative to an incumbent traditional player that's non-tech enabled. I think a lot of folks would point to the classic, what was the difference between WeWork and IWG? One had done co-working and office space forever. But WeWork came in with the technology veneer, and suddenly the multiples are different. And but then obviously, when interrogated more deeply, folks realize that there probably isn't a 10x in margin here between an IWG and WeWork, even at maximum efficiency and maximum scale. And I think those are some of the things we started to grapple with as we went down that path. So that's just on, should we own the cars or should we not? Then there's, should we serve gig workers? Should we serve consumers or should we serve small businesses? All fundamentally different choices. And so there are a number of these choices that we have been presented along the way, some of which we were able to travel down just a few yards before realizing, this is not going to lead to product market fit, to kind of use the sort of pop culture term, and that we need to wind it back. But in other cases, I think some of the mistakes that we made was maybe going down multiple paths in the maze simultaneously, thinking that actually increases your chance of success, because you're thinking, diversification means I'm limiting risk or reducing risk, and therefore I'm actually increasing my chance of actually finding this product that will deliver this elusive product market fit, versus having a singular focus on one path in the maze. I think that's one thing that I definitely take away as a key reflection when I think about our journey through the maze. The other thing is that your time in the maze is really linked to the amount of capital you have. And, so if you I think for a long time, we thought that capital will always be there. As long as we grow, we show up with our metrics, capital will always be there. And obviously that assumption was proven false. Being a first-time founder, I'd never seen a bear cycle before, so I didn't fully appreciate what that meant. And so like now I actually think about this more as I think my idea of the maze has evolved. I think about it more as an idea battleground. And I used to play as a kid. I used to play this game, may not know it, Age of Empires. And it was a strategy game where you start off with like a little village or a villager. You're kind of dropped at this spot on the map. The rest of the map is all blacked out until you go and discover what's there. The goal of each round of the game was to conquer whichever other empire was evolving. You needed to evolve faster than the other empire, and you needed to collect resources, build up your military force, build up your food stockpiles, and evolve your empire, so to speak. And I think that draws very strong analogies to the journey, where we maybe over-indexed on some things that, proven to be less useful if we just kept the perspective of limited resources, always operate in an environment of scarcity, and try to focus on one specific strategy. So if this is a largely, water-based map, a naval fleet would make sense to conquer the other empire versus ground infantry. And what do we need to prioritize if we're focusing on the naval fleet versus ground infantry? And I think that's where the experience for me in mobility now, I'm a decade deep. That's where my advantage lies. Is even though the map is blacked out, I have a sense that this is largely going to be a water-based, landscape here. So irrespective of where the other empire is and what their military force is, how sophisticated they are, we need to focus on a naval strategy, as an example. So I think that thinking has evolved, and my relationship with capital has also evolved as a result, but not without any casualties of war. So I definitely feel like I've, figuratively speaking, lost a limb in the process. Which
you could argue that the map or the maze has changed very fundamentally a couple of times, right? First through COVID, then ZIRP ending. Like it's not only been a discovery of what works in a steady state environment, but in a fundamentally changing environment. So not the easiest time to go through the maze, right?
Exactly. No, absolutely. The landscape was constantly shifting. But I guess that's something that every founder in every era has to grapple with. There are different challenges that come with every era of building, every sector, and yeah, I guess that's just a part. It's just a part of the process.
True. And Tinashe, I was interested with what you said about not going after several directions at the same time, and that your lesson was to go after one at the same time. Why is that so important?
Yeah, so I think now for me, I realize diversification early on is actually a dilution of impact when you're a small team. If you're spreading your resources across multiple bets versus consolidating all your effort, and thinking towards one specific problem and solving that really well, convincingly, and repeating that over and over again. So when I think about the choice to be in Mexico and South Africa, that's definitely one I might have, taken, a different approach to. I think the initial exploration was right, but once our two businesses started to deviate in business model, so what happened was our Mexican business never shifted away from the ride-hailing market or the worker model. So we're very focused on weekly subscriptions for workers in Mexico, while in South Africa we had almost we removed that ride-hailing worker model completely, and that was fully consumer-focused. And not only consumer-focused, but consumer-focused with third-party infrastructure, with the network of an Avis or a Europe car. While in Mexico, we're raising debt, running our own cars, having our own lots, our own fleet management team. While good in theory, it seems like we're diversifying and figure out at what point do we pick the winning model. I think it was a distraction, and it would have been, prudent to. In fact, some of our shareholders gave us that advice, but maybe we were a little too naive in an era where it felt that capital was easier to come by. That just being one, and there's several examples of us, maybe being diluted in our focus, like pursuing motorcycles and cars and light commercial vehicles, thinking, oh no, but it doesn't matter what type of asset it is, we can just add it in. This is a platform. When realizing that it's a platform linked to an operation that has very complex machinery, that being another fundamental, difference. So I think that's one of the things that I would really, reconfigure given the opportunity. And that's why now with the current iteration of Flexclub, we're very focused on just one thing, which is the South African market. We're focused on right now and for the short to medium term on the consumer, knowing that there's a massive opportunity there. Many consumers, millions of consumers in South Africa aren't able to access traditional vehicle finance anyhow. In fact, 70% of vehicle finance applications in South Africa are declined. And there are over 3 million vehicle finance applications in South Africa alone. So you're looking at 2 million people that have demand for a new or newish car, and that demand is unmet.
That's a big opportunity to start off with, right?
It's a very big opportunity, absolutely.
And Tinashe, you also mentioned your relationship with the capital markets changed, and you even losing a limb, so to say. Could you elaborate a bit on what you meant there and describe the journey when it comes to your relationship to the capital markets?
Yeah, so I think we started to really focus on a combination of debt and equity, especially considering we had this captive fleets that were building in parallel to also having this platform, working with established fleets. The evolution of our consumer work in South Africa, where we were carrying credit risk, just meant that there was an imbalance between the size of our portfolio. I mean, just to kind of zoom out a little for context, I always draw parallels to someone trying to build an insurance company from scratch. If you think about an insurance company is just basically balancing the scales between the premium revenue you receive for every policy and the claims you pay out. You obviously want the premiums you receive to be higher than the claims you pay out. Otherwise, you're a loss-making insurance company. And I think that's exactly the dynamic we had. Even though we didn't own the fleets, we're carrying the risk. It's a risk game. How much are you being compensated for the risk, and how much do you have to pay for carrying the risk every time someone doesn't actually pay you for the subscription? And so when the shift in capital markets happened, we were in a space where our portfolio was subscale, and folks were less interested in basically providing the equity capital to fund that gap, allowing us to get to scale. Because also getting to scale wasn't just a matter of time. We needed to continue to invest in the growth channels that we had identified. We needed to continue to invest in beefing up our team to improve our underwriting. And so now without that capital, we had to wind back. First of all, land on a different business model that didn't carry risk. And so that just meant, unfortunately, we had to downsize our team significantly. And not just once, multiple times, because we didn't fully appreciate, or I didn't fully appreciate, just how significant this capital markets shift was. The recalibration didn't really, set in my mind in 2022. But come the end of 2022, it was clear to me that this was a crisis, and by that point, I think we were staring disaster in the face. We were just a few yards from falling off the cliff, and that actually just led us to a difficult process where we had to, work with some of our existing shareholders to take another swing at a different branch of the idea maze. One we had conviction around, but we hadn't shown any revenue proof of. And that can obviously be quite, I guess it could be quite a difficult thing for an investor that's been there for a long period of time. Some might have fatigue of hearing the story of us venturing down different paths in the maze and saying, guys, I'm actually not sure that you guys are going to get there. Mm-hmm. So I'm going to just sit this one out. While others saying, I will take another swing, but in order for me to take another swing, I need to have a bigger upside, because I'm taking more risk here, considering where the business is and the likelihood of the business actually getting to profitability or being able to sustain itself. And we then had to kind of move towards what's typically called a pay-to-play. So pay-to-play-like scenario. And yeah, through that, I think I went into that with a very different lens of treating the capital as extremely scarce. Not that I didn't treat it as scarce before, but trying to think critically about how to get maximum impact with the least amount of spend. Mm-hmm. So I think about the current version of Flexclub. We're a very, very small team, and yet the impact we've had has been significant relative to what we were able to achieve, before with the previous product. So I think that's really one thing that's changed fundamentally for me. Is my ideology around capital has changed.
Got it.
I kind of think about capital now as, to some regard, or to some extent rather, you're almost borrowing from your future exit. So borrow frugally.
It's about thinking through and putting the bar much higher when it comes to return on investment for the initiative that you take. Is it also trying to be as little dependent on outside capital as possible?
Yeah, I think there's an element of that. I think, or at least having clarity on what it takes for your business to be able to sustain itself just through revenue. And the growth you're getting from customers. And that's obviously the ideal place to be. It's not saying that capital itself is a bad thing, but I do think capital at the right time is great to accelerate something that is repeatable. But don't use capital to kind of mask the lack of that repeatability. And I guess now that's why it's clear to me that this pursuit of product market fit should be done with great discipline. Mm-hmm. And I think maybe a lot of businesses, startups, founders went through the journey of sort of pre-2022 just optimizing for the metrics. Our revenue growth is up. It doesn't really matter what we're doing underneath as long as we kind of have the right signals. And maybe even some investors weren't interrogating that as deeply. Just kind of go on the eye-watering percentage growth numbers. Where now the discipline of saying, look, I'm actually happy to just go 2-3 years, a lot slower, very lean, just to make sure I get this product right, make sure it's repeatable, make sure I understand why this technology is 10x relative to the status quo. As a technology business, that is. Obviously, there are tech-enabled businesses out there that are also raising venture. They might not necessarily have the sort of 10x story. But I think we made the choice that now in this iteration, we want to be clearly a technology business and not confused as to what we are, which means that we need to just have a product that we can prove is repeatable, and we don't mind going slower in the process.
And what do you look at to determine whether there is product market fit? Are there specific metrics you look at? Is it uptake? Is it maybe qualitative feedback you get? Like what set of indicators do you look at to know it's there?
Yeah, look, I mean, I think it's going to vary from business to business, but look, for ours, I think at a very high level, I think it's figuring out whether your sort of revenue generation efficiency is increasing. So are we actually just getting more revenue for the underlying operational infrastructure we have running this business, operational and technological infrastructure we have running this business? Because you almost want to feel that revenue is actually pushing you back into your seat. The market is pulling the product out of you at a rate faster than what you can produce, which is, I guess, the sort of famous or more sort of YC version of the product market fit description. And I think that's true. We just go a step further to just like really look at what are our costs to produce this revenue, and how are we confident that we're now at a point where every incremental dollar of revenue we produce is being done more efficiently than before, than last week, and that there's consistency in that efficiency growth. So that for me is like one signal we're using as a North Star today, and several inputs there.
Yeah, makes a lot of sense. Hey, Tinashe, I want to shift gears a little bit and hear a bit more about your personal journey and what you've learned through starting Flexclub, how it has changed you. Could you tell us a bit more how you personally have evolved through starting the business, trying different business models, and building it over the last 6 years?
Yeah, sure. So, like I mentioned, a first-time founder, I hadn't done this before Flexclub. I'd obviously been in the tech space, through Uber for a reasonable amount of time. I guess in the tech world, a reasonable amount of time, but had never really been on the battleground. And I think a lot of my ideology that I came into the battleground or onto the battleground with was formulated during my time at Uber and what I witnessed at Uber. There are pros and cons to that. Obviously, I mentioned that the environment that Uber provided to anyone that was an operator within the business, during sort of that pre-IPO era, was very, very unique. Some might even say once in a lifetime, to kind of have a technology business that impactful at that scale globally, that empowering for entrepreneurially minded operators. I think I overestimated just how difficult it would be, or rather underestimated how easy it would be to replicate that. And I think I've now switched to a world where I'm a lot more conservative, about choices around scale, ability to attract capital, and also just the dependency on capital. Where now I really like the idea of being able to. There's nothing that shows better proof than having a customer base that sustains a business, and the business is doing well on its own cash, and really growth is just an accelerant, not a critical fuel required to continue as a going concern. So that's been a fundamental shift through the journey for me as an entrepreneur. I think I've lost over the last 2 years, like I mentioned, figuratively speaking, I've lost a a limb, on the battleground, it was a personally difficult thing. There's some relationships that get broken, through a process like that, where you're navigating. Obviously, if you have shareholders that lose out on, mistakes or choices that you make, that's challenging. Some folks maybe have, been in the game. We had quite a few angels that supported us in our journey. Some folks had been in the game, for quite a bit as technology investors. So, they kind of have seen the mix of zeros and ones in their portfolios, while others kind of hope that everything's a one. And when you're not a one, even as a first-time founder, you do feel a sense of guilt. At least for me, as a first-time founder, not really understanding the nature of the game. So that obviously is a difficult process to go through. Where when I started the journey in 2018, I was just full of optimism. Nothing could have broken me. Where I think come 2023, there were a lot more cracks that were now starting to kind of really creep in, questioning a lot of things. But thankfully, I also had shareholders that also had a great deal of optimism despite that. Despite seeing some of their portfolio collapse, continue to be supporters and really help me through that process. And that's also helped redefine who I am as an entrepreneur now. Having the confidence to stay in the ring. I think for a long time, I definitely strongly contemplated just exiting the ring and finding an opportunity with a well-capitalized business and forget about the stress of trying to build a startup and find product market fit. But there was another big part of me that just felt that this story was unfinished. I almost just couldn't shake this feeling that, on this battleground, in this maze, the part of the map that's blacked out, I'm certain that there is a victory to be won here. It's non-obvious, and I just needed to course correct some of the choices. So, given the opportunity, I would always choose that.
And Tinashe, was that a conviction based on your image and what you've learned about the idea maze, or was it also inside of you in the sense of that you wanted to keep going, maybe show, take investors, take customers to the part of that maze where it would work? Like, was it very much driven by the opportunity, or also something inside of yourself where you wanted to build that company?
Yeah, I think it's probably more the latter, although it's certainly a mixture. So I guess there are many signs for me through the years. Like I said, it's been almost a decade now. I've been literally thinking about the same problem, from different angles for a decade. And it's obviously everything's clear in hindsight, but I realized the error of my ways before and the assumptions that I had. But I definitely I'm just committed to figure out how to find the product. There is a product here. The market requires it. Just because, like I mentioned, some of the stats in South Africa, but those stats are obviously very different everywhere else in the world. Look at the automotive industry, where mobility is going. Something has to give. And I don't think the models that exist are doing enough. I think, there's been progress, but there's a lot more. There's a lot more to be solved. And the upside of solving it, I think, is significant considering what mobility means to the world.
Totally agree. It's clear that it's both huge, like very important for people, and also changing very rapidly. Uber only being the beginning, but many other business models popping up. So I can totally see that.
Absolutely. I guess for me, my personal story is just now so attached to it that until I feel strongly that everything I thought was wrong, and that maybe there isn't the upside, I'll always take the privilege of continue to tinker in this market.
Mhm.
So my personal identity is just so deeply tied to figuring out problems in this mobility sphere.
Got it. And were there any self-limiting beliefs that you got rid of? I can imagine in a way being so bullish on everything, like based on your Uber experience, might in a way be a self-limiting belief. But were there other things that you learned about yourself and let go of throughout this process?
Yeah. So I think it was interesting because prior to sort of 2021, there's a lot of self-doubt that went into my fundraising processes before. Then 2021 came along, and a lot of the strategies that we followed in 2021 were a lot more aggressive and reminded me more of my Uber days, and that felt unnatural, which was strange considering coming from Uber, where there was nothing wrong with being bold. You're used to making bold moves, but when I flipped over to being a founder responsible for my own cap table, I became a lot more conservative initially. I would say the first few years. Some of that is maybe cultural. I think by design, South Africans tend to be a lot more conservative than other cultures. And then 2021 came along, and we had this success on a rapid fundraise and all this interest. And first of all, I started to question then whether my culture and my inclination was limiting. And then I tried to, quote unquote, reprogram myself in 2021. So then posture as, the entrepreneur that has eternal optimism and that, can raise capital with confidence, even when all the answers aren't there. And I think that actually ended up, funny enough, being just a limiting approach in 2022, because I didn't reckon with the gravity of how significant the shift was in capital markets. Where I think the old Tinashe might have maybe taken a different approach in 2022. The current Tinashe is definitely relieved of that, but like I mentioned, not without a traumatic process, getting to the side, and again reprogramming myself, and now feeling that my views, my ideology as a founder, unique to myself, are what's right, for me, and what I think is right for my market and for the type of product I want to build. So I've never felt more aligned like I do now, relative to a different era of Flexclub where we had more capital, a much larger team, which has been also a fascinating reflection for me.
Got it. Yeah, and relative to who you really are, right? Versus, for example, the posture you took in 2021 that you just described.
Absolutely.
And Tinashe, you come across as a very thoughtful entrepreneur. At the same time, you're executing relentlessly. There's a bit of friction between the two, right? If you're thinking all day, not much will come out of your hand. If you're executing all day, you might work into a direction that is not very well thought through. How do you balance those two modes?
It's interesting because I guess that's another fundamental difference I feel now. Having a smaller team, just how much more time I have to think. I know that this has been mentioned by several founders that I've followed through the years, but it never really sunk in. But I think it's so important to me and my style as a founder to have that room to think. I think I've seen other founders just like they're just always on, like always just doing something, where I take long blocks of time to research, find analogies, talk to folks in other industries, just so it just helps me strengthen my strategic thinking. To your point, like I think that's just like part of my thoughtful nature. But obviously, you can't get lost in that, because that doesn't deliver revenue, that doesn't move the needle. You eventually need to kind of interpret that data or that information, recalibrate, and then execute again the next day, the next week, in a way that that's impactful. And that's the other thing about having a small team, is that I'm so much closer to everything. And it's the closest that I've been to product, since I launched the business the first time around in 2019. And that's been exciting for me, because I feel like the feedback loops now for us as a company. I also have a new co-founding team, which is also very different. But for us as a group, our feedback loops are just rapid, and it's working well, where our tempo and my tempo just align. I'm able to have these blocks where I'm able to think about things critically, almost wonder, strategic wondering. If I just to use that Age of Empires analogy, is like sending your scout out into a black spot without any intention of attacking anyone, just to expand your view of the map, is equally important. And so now I'm able to kind of be in scout mode, just explore, but then come back and focus on, okay, fine. We need to build, we need to build a farm, we need to build a fishery, we need to build the fleet, the military, etc. Like that, both modes energize me, through the week. But I'm also very careful to make room for both modes.
Got it. And 100% makes sense, especially, in a fast changing landscape, like doing both at the same time, balancing that way is super important. You mentioned other founders that you're following and that you respect and learn from. Like, who are the ones that you're inspired most by, or that you learn from most, and what did you take away from other founders' journeys?
Yeah, so I take a lot of pieces from different folks. Obviously, there are the big names that folks will identify. So the likes of a Brian Chesky, followed his story in particular very closely, through the years. And obviously, I guess it's quite topical now, considering all the noise around founder mode. But I actually, I've always loved his perspectives and just how authentic they are. I've also loved kind of listening to voices like Mark Andreessen. Interestingly enough, in fact, this idea of the idea maze has really been fully embraced by Andreessen Horowitz. And Mark Andreessen in particular has left a lot of commentary through the years on it. But the likes of him and Chris Dixon have expanded on that. Obviously the likes of a Paul Graham, even a Gary Tan, Michael Seibel. Well, these folks are, now they're not considered founders, because a lot of folks think about them through the investment lens. Their sort of DNA is founder DNA. And so when they speak, or offer advice, it comes from a place of experience, not from a place of theory. And so I always look for opportunities, kind of whatever they're putting out there, and anyone adjacent to those ecosystems. Obviously love to hear commentary from, the folks like the besties. The All In podcast is a podcast that I follow often, just to hear different perspectives. Not everyone on there is necessarily a founder, but yeah, I think still useful to hear voices like that. And then they're much smaller voices that may be less known, to your audience, that follow on LinkedIn, that are closer to home, that have built businesses in Africa. Not all of which are technology businesses. And so I mentioned how I for one, love to think about strategy, through analogy. It's not the be all and end all. In fact, one of the pieces that Chris Dixon did, when he expanded on the idea maze after Balaji did it, he kind of walks through, these 4 different things that a founder can leverage as they build, and sort of the tooling you might have. You can, build by analogy. You could build based on experience, build by looking at history. Now the fourth one is eluding me, but I certainly draw a lot from this notion of like building by analogy. So it's always been something I've done through the years, and now with telco and seeing just the journey we're going through mobility. We're moving to usage-based billing, prepaid billing, how significant, impactful that was in South Africa when it launched in the mid-90s. It proliferated access to mobile telecoms. So a lot of the founders now, or a lot of the leaders, not even just founders, that I speak with are telecoms executives, understanding what were the challenges and difficulties that you faced in the 90s? What about the 2000s? How do you feel about where telecoms is now? How do you think about the value chain? And so those a lot of those folks have continued to just give me incredible counsel, especially over the last year. And I follow a lot of the stuff that they do very closely.
That's clever. Can you imagine it really helps you look around the corner basically and think through stuff that you haven't experienced yet, but that they've probably dealt with 10, maybe even 20 years ago. I really like that. And Tinashe, I'm hearing and reading a lot of critical notes on Europe as a place to start a business. There are founders that are very loudly moving to the US. When you look at capital deployment, Europe is lagging behind a bit, but equally, a lot of people are starting businesses here. A lot of people do well. Could you maybe give your perspective as a founder from South Africa, but operating in Europe on what that's like and what do you think Europe has going for it and what things Europe could improve on?
Yeah, so I'm not sure my perspective is the best perspective, given we're not actually trading or operating on the ground in Europe. For a significant proportion of our time, we were incorporated and set up in Europe, but that came with its own challenges and difficulties. I think some of the frameworks that apply today are still filled with friction relative to the frameworks that apply in ecosystems like the US. And so now in our current product and our current structure, we're now actually tethered to the US more strongly than we are to Europe. And it's always been a feature of our business that the vast majority of our investors were American. I've thought about that in particular. It's not for a lack of trying. We've certainly, through the years, pitched to multiple European investors. For whatever reason, and this could also just be a personal experience thing. That's why I say I'm not sure I'm best placed to answer this. But for whatever reason, I think the appetite for making bets in Africa generally seemed higher in the US. Despite the proximity, even if you just look at time zone, being stronger in Europe. And I think, culturally, I think my observation is that culturally, Europe tends to be very much an inward-looking, ecosystem, not necessarily, trying to drift too far at, supporting or backing plays to, build big, bold things in other territories, where the US has definitely built a motion there. Done that, US investors have been doing that now for some time. Find they have retreated, since this bear cycle started. But you can just expect them to bounce back and continue to make bets on emerging markets with great conviction. Where I think I have seen a lot of commentary around Europe and its approach to regulation and what that does for technology businesses. Why is it that we're not seeing the same number of technology outliers, breakout successes at the same sort of per capita rate as you do in the US? There's some questions to be answered there, and I don't feel like I'm placed to answer that. But my own personal experience is definitely one of excessive friction in managing a structure, out of at least a global structure out of a European domicile. I think it could be very different if you ask a founder who's operating, say, obviously I'm based in Amsterdam, but operating in the Netherlands and is building tech for the Netherlands for a Dutch consumer base or a Dutch customer base, not even Dutch, but even European customer base. They might tell you, oh, this is fantastic. Everything's great. It's smooth. It's easy. I understand what to do, how to do it. And some of this also maybe, also just cultural. But, for me, trying to build in Africa, it just became increasingly clear through the years that it was easier to tether my business to the US structurally than to Europe.
Got it. Yeah, and we'll for sure continue to ask this question to other founders as well. It's super valuable to hear your perspective. And surprising indeed when it comes to appetite for investing in African business. So that's really that's surprising and interesting to hear. Tinashe, it's been an absolute pleasure to talk to you and hear more about Flexclub journey, your journey, the idea maze. Really learned a lot, really inspiring. Do you have any last words before we wrap up?
No, I think it's been helpful to kind of reflect on this. It's the first time I've actually had a conversation like this since coming out with our new skin, the new version of the business, and my new ideology. So thank you for the opportunity to chat through this. Some of these ideas are maybe not even fully formed yet. I hope it's interesting enough to those folks that will be listening. But I've enjoyed being able to kind of spar on some of this and share my thoughts on these topics.
Awesome, absolutely, and I'm sure the audience will enjoy all of this. And of course, anyone listening, don't hesitate to also reach out with feedback, any learnings in this category. Let's make this as interactive as we can and as helpful as we can. And for now, Tinashe, thanks a lot, good luck, and look forward to speaking soon.
Thanks a lot, Ruzane.